In this video, I'm going to break down the real differences between an LLC and an S-Corp in 2026, and I'm not going to give you the same recycled tax advice you have already heard 100,000 times. By the end of this video, you'll know when switching to an S-Corp actually saves you money, and you will understand the brand new tax law changes that most CPAs have not updated their clients about. And you will learn why the entity your CPA recommends to save you on taxes may have quietly exposed every personal asset you own. The last part is the one no one talks about. And this is the reason a tax professional alone is not enough to make the decision. But here's what makes this different from every other LLC versus S-Corp video on YouTube. Most of those videos were filmed in 2023 or 2024. The tax code has changed since then. A massive piece of legislation called the One Big Beautiful Bill Act was signed into law last year. That single bill rewrote the rules of every pass-through business owner in America. A major deduction that was supposed to disappear, it became permanent. The income thresholds shifted. New provisions were created, and federal auditors ramped up their focus on business owners who play games with their pay structures. None of that existed when those older videos were made, and none of those videos talked about the asset protection side of this decision, because the people making them are not lawyers. I'm Santiago Cueto, board-certified international business law expert and best-selling author based right here in Miami, Florida. I work with business owners every single day who are making costly entity structure mistakes because they are getting advice from only one side of the equation. Tax savings mean nothing when a single lawsuit can wipe out everything that you've built. So let me walk you through both sides of this decision. Let's start with the biggest misconception in small business planning. Most people treat the LLC versus S-Corp decision like they are choosing between two completely different structures. That is wrong, and the reason why so many business owners make the wrong move is because nobody corrected the misunderstanding early enough. An LLC is a legal entity. You form it with your state. It gives you liability protection. It separates your personal assets from your business debts and lawsuits. That part is straightforward. An S-Corp is not a separate entity at all. It is a tax election. It is a choice you file with the federal government that changes how your business income gets taxed. Your LLC stays an LLC. Your operating agreement stays the same. Your business name stays the same. The only thing that changes is how the government treats your profits. I call this the entity identity crisis. Business owners think they need to choose one or the other. The truth is, you can be both at the same time. You form an LLC for the legal protection. Then, when the math supports it, you elect S-Corp taxation for tax savings. One entity, two purposes. Now, here's where it gets critical. And this is the part your CPA almost certainly skipped. This is the section of this video that separates what I do from what your accountant does. Because CPAs think about taxes. Attorneys think about protection. And when you only listen to one of them, you leave a gap wide enough to lose everything through it. I call it the asset shield gap. It is the blind spot that opens up when someone picks a business structure based purely on tax savings without considering what happens when a creditor, a lawsuit, or a judgment comes knocking. Here's what I mean. Not all business entities protect your personal assets the same way. On the surface, both an LLC and a corporation give you liability protection from your business debts. If someone sues your business, your house and your personal bank accounts are generally off limits. That much is true for both structures, but the protection works in two directions, and the second direction is the one nobody explains to you. The first direction is inside protection. That is the shield between your business liabilities and your personal assets. Both LLCs and corporations handle that reasonably well. The second direction is outside protection. That is the shield between your personal liabilities and your business assets. What happens when someone sues you personally and tries to grab your ownership stake in the business to satisfy a judgment? This is where LLCs and corporations are not equal, not even close. When you own shares in a corporation, a creditor with a personal judgment against you can seize those shares. They can take ownership of your stock. And if they get enough of it, they can vote to liquidate the entire company and sell off the assets to pay your debts. Your business partner wakes up one morning with a stranger sitting at the table making decisions. That is how corporations work. When you own an interest in an LLC, the rules are different. In most states, and especially here in Florida, creditors cannot seize your membership interest. The only remedy available to them is something called a charging order. A charging order gives the creditor the right to receive distributions from the LLC if and when the LLC decides to make them. But here's the key. The LLC does not have to make distributions. The manager controls that decision. So the creditor sits there with the lien on money that may never come. I call that the charging order shield, and it is one of the most powerful asset protection tools in American business law. Now think about this. Your CPA tells you to form a corporation and elect S-Corp status because it saves you a few $1,000s a year in taxes. You follow that advice, you save some money, then 3 years later, you get hit with a personal lawsuit, a car accident, a contract dispute, a professional negligence claim. The creditor's attorneys go straight for your corporate shares. And because you formed a corporation instead of an LLC, they can take them. Your business is gone. Your assets are liquidated. The tax savings you earned over 3 years vanish in a single judgment. That is the asset shield gap. And your CPA never mentioned it because liability protection is not their job. That's my job. Now, I practice here in Florida, so let me explain how this plays out in your state specifically. Because Florida has some of the strongest LLC protection in the entire country, but also has a trap that catches solo business owners off guard. In Florida, when your LLC has more than one member, the charging order is the sole and exclusive remedy for a creditor going after a member's personal debts. That language comes directly from the statute. Sole and exclusive. A creditor cannot foreclose on your membership interest. They cannot force a sale. They cannot participate in management. They cannot inspect your financial records. All they can do is wait for distributions that may never come. That is an incredibly powerful shield, and it only exists because you chose an LLC over a corporation. But here's the trap. If you are the sole member of a single-member LLC in Florida, that protection weakens. A creditor can petition the court to order a foreclosure sale of your entire membership interest if they can show that a charging order will not satisfy the judgment in a reasonable amount of time. That is a different ballgame, and it is the reason I tell so many solo business owners to seriously consider adding a second member, a spouse, a family trust, a legitimate co-owner. That second member activates the full charging order protection under Florida law. Now contrast all of that with what happens when you form a corporation and elect S-Corp status. Your stock is personal property. It can be seized, it can be sold at auction, it can be transferred to a complete stranger who now sits in your chair and makes decisions about your company. The tax savings from the S-Corp elections are real. I'm not disputing that. But the way you get those savings matters a lot. Forming an LLC and electing S-Corp taxation gives you the tax benefits and the asset protection. Forming a corporation and electing S-Corp status gives you the tax benefits, but strips away one of the most valuable legal shields available to you. Same tax result, dramatically different legal exposure. That is the conversation your CPA never had with you. Now let's talk about the tax side, because the tax advantages of S-Corp election are real. The question is whether they are worth it for your specific situation. Hey, quick pause here. If you're finding this information valuable, go ahead and hit that like button. It helps this video reach more business leaders who could use this content right now. And if you're not subscribed yet, subscribe now so you don't miss the next update on Florida business law. When your LLC operates under its default tax treatment, every single dollar of net profit gets hit with self-employment tax. That is the tax that funds Social Security and Medicare. The rate is steep. We're talking about roughly 15 cents on every dollar you earn. That is on top of your regular income tax. You built a business, you took the risk, you did the work, and the government takes a separate cut just because you are self-employed. Not because you earned more, just because of how your business is classified. When you elect S-Corp taxation, the game changes. Instead of the government taxing all of your profit as self-employment income, you split your earnings into two different buckets. Bucket one is your salary. You pay yourself through payroll, and that portion gets taxed like any employee's wages. Bucket two is your distribution. That is the remaining profit after your salary. Distributions are not subject to self-employment tax. I call this the payroll split advantage. It is the core mechanic that makes S-Corp taxation work. You're not avoiding taxes, you're reclassifying a portion of your income so it gets taxed at a lower rate. But here's the thing that nobody warns you about. The government knows exactly what you are doing, and they require you to pay yourself a reasonable salary before you take a single dollar in distributions. You're probably thinking right now, great, I will just set my salary as low as possible and take the rest as distributions. But that is exactly the behavior federal auditors are targeting in 2026. A reasonable salary means the amount you would have had to pay a qualified stranger to walk in and do your job. Not a convenient number, not a low number. A market rate number based on your role, your experience, your industry, and where you live. I've seen cases where business owners paid themselves a fraction of what their position commands. They thought they were being clever. They got audited. Their distributions were reclassified as wages, and they ended up owing back taxes, penalties, and interest that totaled more than what they saved over several years combined. I call this the salary trap. It is the gap between the tax savings you thought you would get and the penalties you actually receive when the government disagrees with your number. The so-called 60-40 rule you see repeated online, 60% salary, 40% distributions, that is a myth. No government agency has ever endorsed a fixed ratio. Every reasonable salary determination depends on your specific facts. What actually protects you is documentation, a written analysis explaining how you arrived at your salary. Market data showing comparable positions in your area, a formula resolution in your business records. That paper trail is your armor, not a number you pulled from a YouTube comment section. Now here's the part that most CPAs have not fully absorbed yet, and honestly, this is the other reason I made this video. There is a powerful deduction called the Qualified Business Income Deduction. It allows eligible pass-through business owners to deduct up to 20% of their business income before calculating their tax bill. That deduction was supposed to expire at the end of last year. Then the One Big Beautiful Act was signed last summer. That deduction is now permanent. No expiration date, the income thresholds were expanded, and a brand new minimum deduction was created for small operators. Now, if your CPA gave you entity structure advice before the law was signed, that advice may already be outdated. But here's where it gets tricky. The QBI deduction and the S-Corp salary split creates a tension that most advisors do not model properly. I call that the QBI paradox. When you elect S-Corp taxation, your salary gets excluded from the QBI calculations. So only the profit left over after your salary qualifies for the 20% deduction. So a higher salary means a smaller deduction. Some CPAs stop the analysis right there and tell their clients to stay as a default LLC. But that advice is incomplete. The self-employment tax savings from the S-Corp election almost always outweighs the slightly smaller deduction. The CPA who only looked at one side of the equation missed the bigger picture. And for higher earners, the math can actually flip in a way that makes a higher salary unlock even more of the deduction. This is why the LLC versus S-Corp decision is not a one-time conversation. It needs to be revisited as your income grows. The right answer at one profit level can become the wrong answer at a higher one. So the question you have been waiting for the entire video, when does it actually make sense to elect S-Corp taxation? I want to give you a simple framework instead of drowning you in calculations. When your business is earning below a certain level of consistent net profit, the compliance costs eat your savings alive. Payroll processing, additional tax filings, quarterly deposits, reasonable salary documentation, that added complexity costs real money every single year. At lower profit levels, your potential tax savings barely cover those extra costs. This is not a tax strategy. That is a more expensive way to file your taxes. But once your business crosses into consistent six-figure net profit territory, the savings start pulling away from the costs. And the higher profit climbs, the wider the gap becomes. I call that crossover point the decision line. Below it, keep things simple with your default LLC. Above it, sit down with a qualified tax professional and business attorney. Model the tax savings, but also evaluate the liability exposure. Make sure you are forming the right legal entity, not just checking a tax box. And when both sides of the equation favor the switch, make the election. And timing matters. There is a firm deadline each spring to file your S-Corp election for the current tax year. Miss that date and you have to wait an entire year. So if you're anywhere near that decision line, start the conversation now. Let me bring this full circle for you. The LLC versus S-Corp decision in 2026 is not just a tax question. It is a legal question. And the answer changed when the One Big Beautiful Act became law last year. The QBI deduction is now permanent. The income thresholds are wider. Federal auditors are cracking down on unreasonable salaries. And the entity you choose affects far more than your tax bill. It determines whether your personal assets are shielded by one of the most powerful protections in business law, or whether they are sitting out in the open waiting for the wrong lawsuit to come along. Tax savings do not matter when a creditor can seize your corporate shares and liquidate your company. Form the right entity, get the salary right, document it properly, model the tax savings and the QBI impact together, and stop relying on advice from someone who only sees half the picture. Now, if this video helped you understand the LLC versus S-Corp decision, hit that like button right now. That one click helps this video reach more business owners who need this information. And subscribe to this channel so you never miss a new video on business law, tax strategy, and entity structuring. I'm Santiago Cueto, your Florida business attorney. Be sure to watch more of my videos right here.